a put credit spread that I have, and then we'll talk about what I did with it, and then you guys can talk about what you would have done differently. So for those of y'all that watched the channel earlier today, Option and I have already dissected this trade, if you will. So we're going to start with Meta. I did a put credit spread. I sold these on the 24th, I believe, of January. So I sold the 590 and then I bought a little bit of insurance. I bought the 575 to make it a defined risk strategy. So in real basic layman's terms, I am just cheering for Meta to stay above $590 by the expiration date, which is in a little over a week on 2/7. And for doing so, they paid me $2,550 for tying up $15,000 in collateral. So a lot of people are like, well, how do you know the collateral? It's simply the width of the spread multiplied times 100. Multiply that times the number of contracts. So 1,500 times 10 is $15,000. So in my little simple mind, I was just thinking, okay, cool. I'm going to tie up 15 grand for about, 15 days or whatever it is. And you're going to pay me $2,550. And the mindset was, I'm interested in Meta at $590, but I want to sell a cash secured put down there because I'm tying up a lot of capital, because now we're talking about $59,000 a contract, and they weren't really paying a whole lot of premium. And I'm not really feeling that ballsy right now to where I want to do like a cash secured put at like 620 or 630, which would have paid me a lot more premium because Meta had earnings coming up, which were today. So I was just like, well, let me participate. I know I'm going to watch it anyway. I'm going to watch this stock. So let me see if I can just ring the cash register a little bit. And if Meta tanks, now I'm going to be interested because I have the capital to turn this thing into a bona fide cash secured put. So that was the mindset. I want to start from top to bottom. Dallas, tell me what you like about the trade, what you don't like about the trade, and what you would have done differently given the circumstance.
I like the strategy. We spoke a little bit about this today. I do also like going a bit out of the money. For me, sort of the tasty trade way is obviously you need to collect ideally 33% of the width of the spread. I'm someone who's willing to go even, and I've even heard Tom say like he'll go down to 25%. But that's like a bare minimum. Like you got to have at least 25% of the width of the spread in the premium that you collect for these put credit spreads. So try to get bare minimum 25%. That way, if it does go against you, you're collecting more of a credit in order to help you, manage the trade that's gone wrong. For me, though, I'm looking to use a put credit spread where I'm not super confident in if my trade is going to go in my favor or not, but it's a company that I'm interested in. Or if we're in just a bull market where, you look at Meta, the moving averages are so far away right now. Even the 50-day moving average right now is like 604. So we got to come from 676 to 604. The 200-day moving average is 538. So those would obviously be ideal spots to, sell a put, or a put credit spread would be when it comes down to one of those moving averages. Not everyone loves technicals. I do like basic technicals, support and resistance, as well as moving averages. But, in a market that we're in right now, Meta's not giving us those. In a market like we're in right now, I like to use the 20-day moving average. So maybe $629, and most likely it would, pull back to the 20 and then continue moving up. But if I'm really not confident in the strike price, in other words, I don't want to take ownership. I wouldn't feel good about taking ownership at 590. If my put credit spread does go wrong, I would look at, you know what, this is a defined risk anyway. I'm just going to go ahead and take the loss on the defined risk. Then I'm going to open up some actual cash secured puts at a level that I actually want to take ownership. So that would allow me, it's already a big down move coming from 676 to 590. And then if I take that loss, now we're at 590. Now I can write some actual cash secured puts for 560, 550. Now we're coming up to, 200-day moving averages, 100-day moving averages. Then I'm more eager to actually own the shares. So that's what I would do. I would not actually, exercise your long put, cash out your long put, and turn those into regular cash secured puts, because I don't want to manage them at those price points, because I don't necessarily feel that 590 is a great price point that I would feel comfortable owning hundreds of shares.
No, I get it. Awesome. Let's go with Uzi first, and then we'll finish with your option, because we already did a segment on this earlier. Uzi.
Yeah.
You already have all the information. Just a fair constructive critique, if you will, because I'm sure over the course of your career, you've done a put credit spread or probably 1,000. So what do you like about the trade, and what would you do differently, if you will? Any words of wisdom that you can share with me and the audience?
Yeah, sure. So real quickly, I'm a visual guy, so I had to write, the notes down, what you did, and then look at it, because I'm that's just who I am, because I'm probably old. But pretty impressed by Dallas, because I don't know if he was looking at a chart or whatever, but he nailed the 200-day moving average. He nailed the 20-day moving average pretty much to a T on his numbers. So I'm like Dallas in the sense I'm a technical guy. I'm all technical. And I love this trade because, first of all, while I agree with Dallas, you want to try to get maybe 25 to 33% credit on the width of the spread, I don't use that as a hard and fast rule at all, because a lot of times that's hard. And to get that, everything has to pretty much line up right. And then even then I've done those and it doesn't necessarily work out. So I'm fine with, like, yours works out to be 16%.
Right.
16.6%. So that's fine, especially given the fact that your strike price is all the way down at what's the 88% retracement fib level from its most recent base area. So it's going to have to make a far drop to get to that level. So I love it because it's far away. And I love also that you have about a 90 to 92% probability of profit, because you sold basically an eight delta strike. So you've got a lot of the positives right there. The only thing I don't like is this stock has been up in price, closing price, for the last 8 days. And generally I wouldn't be selling a put, but because it's earnings and it has the chance to really rip up, or if it's going to fall, I mean, Meta is one of the biggest names out there to be bought besides Tesla. So they'd be the bottom fishers. So I really don't find anything wrong with this, other than, that many days up before you're putting that on. And if you could have gotten maybe 20%, 25% of the width of the spread, would have been better. But I would do this trade, with you, sure. Just not the same size, but I would do that trade, yeah.
So I think, to give it a little bit more color, I think it's important to go to the day that I put the trade on, right? Because Meta, and I guess we can get even more specific. I don't know if it'll tell us exactly the time that I put it on. No, I guess it doesn't go that, does it? No, I don't think it goes that. Maybe, I don't know. Here we go. At 11:02. At 11:02. So let's go to 124 at 11:02. Your Honor, I want to point to. No, I'm kidding. So we're going to go to 11:02 a.m. TJ has this bright idea that he wants to do this, and Meta is at 6:37 at that point, give or take. Maybe I'm doing it wrong. It's over here. 11:02 a.m. So Meta is at 6:45. So when it was at 6:45, I was thinking, I'm interested at 590. I'm really interested at 550. But if I do anything in the 550, well, there's no juice in that limit. So my idea was, well, let me do it. Let me throw them out there at 590, just kind of as a feeler bet. I'm going to be looking at this thing. I'll probably even listen to the damn earnings call, but I don't even have a dog in this fight right now. You know what I mean? So I feel like I'm going to waste a lot of my time. So I want to have a little skin in the game. So this was the only way that I could justify having skin in the game. These are all the, you know, a lot of the thoughts that were going on in my head. And obviously now we see where it's at. So there's a real good chance that I wake up tomorrow, provided that this move holds. And this thing's probably in the 75, 80% range tomorrow. And provided there's enough liquidity, I might just be able to take the trade off the table and lock in a win and call life good. So let's talk about that aspect of the trade now option. And I would like for you to chime in. When do you call life good on a put credit spread that's gone your way? You have something to add, Dallas?
Yeah, could you just explain? I know in the past, a lot of times you've done $5 wide strike spreads. Can you explain why you chose to do $15 wide this time?
Dude, you don't even have a rhyme or reason, dude. It literally was just one of those things that, like, have you ever gone to the gym and you're like, I'm going to work shoulders, and you end up working legs because it just felt good when you walked in there? No, I'm serious, because normally
that never happens. I don't ever go to the gym meaning to do something and end up training legs. But I can tell you, I've many times gone to the gym. And I said, I'm training legs. And then I saw a pretty girl and I said, it just became arm day.
Yeah.
International Chest Day.
Yeah.
So I'm weird. When I'm like really in the zone, I actually enjoy training legs because I have really skinny legs by nature. So I feel like I got to work them that 2 or 3 times a week to really try to get anything out of them. And then I was also in powerlifting, so the legs were like everything, right? But anywho, yeah, so I don't know. I really don't know. I think maybe I was telling myself something like, if I buy the put way out of the money, like you know, pay less for the insurance, maybe it increases my profits or something. I really don't know. Like, I don't have like an actual reason, whereas if it's just like a standard cash secure put cover call, I'm down. But this is showing where this is a lot lower in the word chest for me, right? This is not a go-to move for me, but whenever I do them, I tend to have pretty good success with them because I feel like I'm chicken shitting with them from the standpoint that I'm like so far out of the money. I'm almost daring Mr. Market to actually challenge me. Do you have something you wanted to add, Uzi, before option takes the floor?
Yeah, and I'll be really short and quick. That was a good question, Dallas, and I didn't think to ask that. But here's the thing: I thought you did it just because you have, let's say, a nice size account. But I would have to say, to start a position of a spread, I don't like to go that wide, because if you have to open it up because you have, well, then again, you're willing to take possession. But if I'm working with somebody,
I'm willing to close out the long and
yes,
turn it into a cash secured put.
Yep.
Manage that cash secured put in the back of my mind, knowing that if I still don't want to keep tying up that collateral, I could just buy another long call and release all that collateral, right? So you can roll in different stages, if that makes sense. Anyway, option, take it away, my man, and educate us on the tasty trade way and everything.
I mean, the way I do it is, you know, for one, like we already discussed, I wouldn't have been in the weeklies, right?
Yeah.
I definitely wouldn't have been there. And that's just due to liquidity, right? And then the bid-ask spread. So I wouldn't have been in the weeklies. I would have been in the monthlies, probably the 23-day. I definitely, you know, I would have had to have gotten at least close to $5 for that spread, right? At least $4.50, because, you know, the way I look at it is the more money I take in, the better for me. I'm willing to risk 2 to make 1. And I want to keep it as close as possible at a 2 to 1. I'm not trying to get 4 to make 1, 3 to make. That's just too much capital for me. And I mean, I agree with the wider the spread, right? Because you want to give those deltas, as we know, we want to give those deltas enough room to move, meaning the short delta from that.
Yeah, because I feel like when you have a 5 wide spread, guys, like, are these deltas just kind of like offsetting each other?
They just
you're almost forced to. You're almost forced to go the duration of the contract, in my opinion.
And you are. You're going to be in there forever. And the thing is, even with a $15, $20 wide, you can still just roll it the whole vertical spread. You can roll it. You don't have to break it down, or I don't like to put on a position and then take off legs, right? Because now, either you adding risk or you have to, add more collateral. If that was the case, you should have just did it one way from the beginning. But
so the reason that I didn't want to, and it's because Bill's in the comments, so I'm going to chime in for him. The reason that I wasn't willing to sell a cash secured put on Meta is we have to go to the genesis of the trade and the genesis of the mindset. Meta is not in an area right now that I'm actually interested in the stock. So this was the only way that I could justify in my mind to be so far out of the money. Yet, if I'm willing to sell enough contracts, I can ring the cash register to where it's still kind of worth my while in my mind. And then I'm going to do the roaring kitty that if this thing starts tumbling down, now I'm kind of leaning forward because now you got my attention. And damn well I'm not opposed to doing a cash secured put because that's what I built my life on. But yeah. I want to do cash secured puts again at prices that I'm actually halfway interested in the stock. And I'm really only interested at 550. So with that mindset, Meta's just not, I'm not able to ring the cash register on Meta if I'm going to stick to my guns at 550. Mr. Market ain't going to pay me shit for doing that. So I was just trying to manufacture a trade, if that makes sense. And then I'm hoping it went against me so that now it could potentially get on the books in a more serious way. But all the while, I was going to watch the stock or stock the stock, like I like to say. And I wanted to stock it to the tune of, $2,500, if that makes sense.
Yeah, but at the same time, even if it doesn't go your way, the objective, I believe, is to make money, right? Regardless.
Yeah.
So my thing is, if I'm gonna, execute a trade, then I'm going to shoot for the highest profit that I can make quickly, right? Because that far out of the money and that far back, you're gonna be in that for a while. And I mean, you got a couple of more days left, but still. You're going to have to be in it for a while, so, and I mean, you only got two deltas. You're only working with two deltas. Your short delta is a 3. Your long delta is your short delta is 6 and your long delta is 3. So you're only working with two deltas.
Yeah.
Right.
So I guess let's just go top bottom because this is what it's all going to come down to. So is $2,550 on $15,000 in capital for about a 12-day trade sufficient? Because that's what it can. And considering where Meta was and now where Meta is, because obviously we know that I won this trade, right? It's pretty obvious now because we saw that we had the answer to the test now. Meta's at about 694, unless it totally tanks in the morning. I doubt it will. Is 2550 on a 14-day trade or whatever the math is on it, right? Give or take 14, 15-day trade. Is that sufficient on utilizing $15,000 of capital? Because I'm going to show you another trade that I did an earnings play, and I played it differently because I was gearing up for this discussion. Because the real discussion I want to have when we're all done is, are put credit spreads more capital efficient than just cash secured puts? Because cash secured put, I mean, let's look at how much money it would have done. It's 10 contracts, 559. You're talking about you're talking about 590 grand in capital is what I would have needed, right? If I would have done 10 cash secured puts at that level, I couldn't justify doing that because it's not at a price point that I'm even really interested, if that makes sense. So it's kind of like playing poker, and this was a bluff. And I was like, if I get caught bluffing, well, then I'll take a stand. But if not, I wanted to cash grab, but I didn't want to use as much capital, if that makes sense. So Dallas, we'll go down the road. Real quick, just a yes or no. For you, given everything that we know about the trade and mindset and the way that you look at the market, you have a lot of experience as well. Is $2,550? Is that enough juice in the lemon for you in this particular situation?
Yes.
Option. I think the answer is no. Option.
No.
Hell no. Go ahead and throw the hell no in there. What about you, Uzi?
Yeah, definitely. It's 17% on your money, and you don't have to wait 14 days or whatever it is, 10 days. You could take that off tomorrow for at least 50% profit, most likely. So it becomes a one-day trade if you really want. And even if you only make 50%, you make it 8% overnight. Yeah, I'll do that every day.
And that's the thing, right? It's great when it works, right? But what about when it doesn't work?
Facts. Yeah, because I think what the point that we don't want to miss here on options mindset is this one's fine and dandy because we already have the answers to the test and it's obviously going to work out for me more than likely, right? But let's say this
do that 2-3 times at the same amount and you take that one loss, you're gonna wipe out all your winnings.
Unless you turned it into a bona fide
right. But that's the key option. And I'm thinking along TJ's mind is that he's gonna sell that long for profit and then take the stock. And then to that point, if I could just add one little nuance, because option knows his business. But here's one thing about the deltas: the further away they are, yes, they do. The closer they are, the more they compete with each other. But if you're going to look to make a profit on that long put, you want it as close to your short put as possible because it's a higher delta. So, no options 100%. But if you are going to look to take advantage of that long side by breaking it open, then you want it closer so you can make more money on that long side. That's the only thing I'd say.
Yeah. Were you aware that earnings would be during that trade? Because that certainly helped you. I would have liked to have known. I would have liked to have seen. I would imagine you would not have been able to collect enough to make it worthwhile.
So I was thinking of little things that I didn't even know they were really going to come into play. But I was like, well, I think I'm going to be the beneficiary of some IV crush, right? Because when you're selling options, you want the IV to be high, and then after the binary event, theoretically, that alone's going to help me a little bit in this trade. This is a little bit that was going on, but it's a little more nuanced. I wanted to keep the conversation a little bit more basic, if you will.